Hello friends, a big welcome to you all at yet another episode of Centrishala. I wish you all a very happy Diwali. And today in this episode, we're here to discuss some recent developments in the Indian equity markets and overall generally the capital markets. I have with me today Vinayak Malhotra, who's the head of products at Centricity, and Mr. Sachin Jasuja, who heads equities and equity strategy at Centricity. So starting with you, Vinayak. So recently we've seen a bit of correction, a long-awaited correction in the Indian equity markets. There have been some concerns about foreign institutional investors pulling out some money, booking profits. Other emerging equity markets looking more attractive and some of their allocation going towards them. So if you could just overall throw some light on this.
Thank you, Aditya. And I would like to wish all our viewers a very happy Diwali. You are right. Actually, if we look at markets have been on a one-directional rally for quite a long time. But if we look at the recent correction, I think it's probably we have seen Nifty correcting by 7-8%, mid and small cap indices correcting by 9-10%. But if you look at historically, I think these corrections happen usually every year, or I would say average. If we see how indices fall during every year over the last 10-20 years, there have been times when indices correct by 10, 15, 20% during the course of the year, and eventually, depending upon how the market is reacting, they'll rise again and they'll move again in the up direction. But yes, there have been concerns. See, markets always find reasons to correct depending upon where we stand today. It's not like we can look at India or Indian equity markets on an absolute basis. Maybe a few months or a few quarters or a few years back, India was looking very lucrative. But as you have said, maybe other economies like China. So investors look at markets in terms of how much value they get from that price, price which they are paying right now. Maybe in today's term, India's long-term growth story still remains intact. We are the only economy which is expected to grow at 7% real GDP levels. But if you look at, maybe the valuation is what right now is little inched upwards, and maybe the foreign institutional investors see China or Japan as other economies wherein there is more value as of now. But maybe over the 2-3 quarters time, corporate earning seasons are already there. So primary reason to the recent correction, I would say, other than geopolitical issues, is I think the corporate earnings results have been little poor. The top line, the bottom line numbers have been relatively subpar. But we believe that maybe over the next 2-3 quarters, the numbers will start improving and we'll be back on track as we have been witnessing in the last few years.
So what essentially I'm hearing is that it is only logical that once in a while, FIs do look for value, look for a better price, move on to some markets which they find are attractive. That doesn't mean that overall they have lost their faith on the prospects of the Indian equity story as such, but overall they also tend to seek value, right?
Absolutely.
And overall, what are the things which you think are going for India, right? So an average investor would often feel that if FIs are pulling out some money, it means that there is something that they are seeing which an average Indian investor or retail investor is not seeing. So is it some cause of concern? Should we also put our brakes? Overall, should our asset allocation go down in terms of their equity allocation? So what are the things which we should definitely highlight to pacify the Indian investor that everything is going right? And to some extent, we have seen that it hasn't really stemmed the flow of domestic inflow into equities. Today's Economic Times has produced a report saying that the effect of FIs pulling out was more or less instantaneously overcome by domestic institutions. But for an investor or the partners that we interact with, what do you say are the top 2-3 factors which are going for India and which we believe will continue for the next couple of years?
See, the main factor that the entire world, whether it's foreign institutional investors, whether domestic, everybody is looking at, India is growing at 7%, as I mentioned. The other biggest economy, which is China, let's say, is growing roughly around 4.5-5%. So see, in the long term, equity markets will behave in line with how corporate earnings are coming up. If our real GDP is growing at 7%, probably in nominal GDP growth rate after adjusting inflation will be somewhere around 12-13%. So in the long run, our earnings should also move in line with 12-13%. I don't see whether it's US or China, their economies, their earnings probably over the next decade can grow at more than 5-7%. So eventually, I think we have to understand that we are the largest economy in terms of growth. Our earnings will grow in line in terms of 12-13% at a nominal rate. No other economy is in line with the rate with which we are growing. So I believe in the long run, expecting a healthy 13-14% kind of equity market returns is fairly acceptable from the market standpoint. And eventually everyone, whether it's domestic institutional investors, retail investors, everybody will start coming in. The biggest point is, over the last few years, a decade back, foreign institutional investors used to be a bigger portion of our overall investable universe in Indian equity markets. Right now, if you look at, there have been retail investors participation also coming into the markets. We have seen a surge in the domestic retail participation in terms of demat accounts have multifold over a period of time. If we look at SIP book, we touch almost 25,000 crores of SIP book. Plus mutual funds, forex reserves are also at all-time high. We are doing fine. Our inflation is in our control. Our fiscal deficit is in our control. So all the macro parameters also look very favorable for the long-term projection. And I don't see that any other country or economy is in such a sweet spot where India is today.
So Sachin, coming to you, so you run a listed strategy, also listed equity strategy, and of course your specialty and where we have kind of established a name for ourselves is in the unlisted space, the pre-IPO space. Given that we have seen less than expected or more or less disappointing corporate results, what do you think? Where do you think pre-IPO companies stand in terms of, is there a cause of concern if their listed peers are themselves finding it difficult to be profitable in this kind of a scenario? How bullish or what should be our main parameter to evaluate an unlisted story or a pre-IPO story to bring to our partners?
Right. So first of all, I would like to wish everyone happy Diwali. Yes, Aditya, the concern is very right on the listed space that most of the, I would say the broader market, we have seen little slowdown in terms of growth in the corporate earnings. So I think one of the reason is that we have seen a very high base effect last year, right? So last year actually earnings, grew really well. It crossed 15% benchmark, which India was not able to cross, right? So the base effect was there, and this is the first quarter where we have seen little moderation in the growth. So we still believe the growth story is intact. The corporate earnings will be there on the annualized basis, in the range of 12 to 15%. And whether it is listed or unlisted, the dynamics of the companies are not different, right? So if I give you one example, that in the AMC, in the asset management world, right? If Nippon is listed or HDFC AMC is listed and SBI is not listed, suppose, but the dynamics are same. So all these companies are growing, very fast. So the debate can be, okay, these were growing by 30%, these may grow in next few years by 25%, if not 30%, right? So that concern is there. But yes, the growth is there. What we look forward into unlisted space, that we are only going for those companies which are growing faster than the listed basket. So there has to be extra potential of generation of returns. Otherwise, why to go for unlisted when there is so much opportunity into the listed space? So if the valuation comfort is there on the unlisted space, if the growth metrics is better as compared to the listed space, and then we see that, okay, the market share is increasingly, market share, these companies are gaining every year. And if we find, yes, there is a good chance of making more returns into some specific unlisted space, then only we are choosing those companies. And we don't see any specific concern over there in specific companies which we are choosing on the unlisted space. If we talk about the broader market on the listed and unlisted, that is almost same. There has been little moderation on the corporate earnings side. But whatever we are choosing for our clients, so we are taking care of that growth path and about the valuation metrics, that those should be favorable for the investor. Then only we should go for those companies.
And that there is, of course, where the team's expertise.
Yes, definitely.
All the ideas that you are generating.
Yeah.
And of course, monitoring over a period of time.
Yeah.
So pretty much answers my question. But overall, Vinayak and Sachin, both of you, if I ask you, for the investor, and for our business partners who are advising their clients, who are bringing ideas to the clients who are also trying to, against all odds, trying to maintain some semblance of asset allocation in their portfolio. What would be your advice? Should there be some kind of tactical movement? There can be some kind of improvement in the portfolio, or what is going on should go on. So we, as you know, we are, in most of our meetings and in most of our seminars, webinars that we do, we always maintain that irrespective of how well the equity markets are doing, the individual's own goals, short-term, long-term, and his asset allocation thereof should not be overly swayed towards how an asset class is doing. If say equity is doing well, doesn't mean that everybody should have 100% allocation to equity. And by chance, if there is a prolonged period of non-performance in equities, does not mean that he should have 100% in FDs or fixed income only. So in this today's scenario, specifically talking about say today, what do you think that overall what should one do in equity? What should one do in other asset class, fixed income? What are the opportunities available?
Yeah, so I would just share my insights on that. So what we have seen in last 3-4 years, from 2020, from the COVID time to now, the market has from Nifty has gone from 10,000 level to 25,000, right? So it is already 2.5x. So by default, even if somebody had given 50% weightage is into debt or equity, so their equity weightage has gone up in last 3-4 years. So some kind of tinkering in the portfolio, because the valuations have also gone up into the equity. So that moderation can come. They can reduce little weightage into equities, considering that maintaining their asset allocation, whether it is gold, debt asset class or equity asset class. I think that can be taken care of at this point of time. I think Vinay can share his idea.
Yeah. See, I think Aditya, we have to see it that how much additional return we can generate from equity at this point of time. As we have said that probably we expect 2-3 quarters of subdued earnings. Probably this is the time, and we have been very vocal in last 2-3 quarters, that probably it's time to move from a little bit towards from mid and small caps towards large caps. So maybe move towards strategies which are towards multi-cap, where the fund manager has the flexibility to decide when to exit from mid and small caps. Maybe some sectors which are overpriced and enter towards large caps, which they believe are at a favorable valuation. Plus, I don't see that moving from equity to debt, your return expectation goes down from a very big margin. I would say today, even in debt, we have high yielding NCDs options wherein you can target at least 9 to 12% kind of returns. There are also some performing credit AIFs, infrastructure AIFs available, wherein also you can target some 14-15% kind of return. So for all investors who believe that, we, as a house, we believe that it makes a good time to right now move certain part of your profits from equity towards debt, but that debt doesn't mean that you will target only 6.5-7% kind of returns. You can definitely target at least 10 to 12% kind of returns. And I believe that looking at where we stand today, there is a lot of merit, and I have to look at risk reward ratios as well. I think looking at performing credit, some high yielding bonds, NCDs makes a lot of sense into the client's portfolio. I'm not denying that equity in the long run will give you high double-digit kind of returns, but these are some, I would say, strategic to tactical calls in between that, wherein we can at least target 12-14% kind of returns for next 3 to 5 years, which we believe equity might give, might not give, but because we have seen a phenomenal rally in 3 years, so the prices have moved way ahead than earnings. And if debt or an asset class which can give you 12 to 14% kind of returns for next 3 to 5 years consistently, I think that makes a lot of sense in client's portfolio today.
Given that there are expectations and there is a slight possibility of rate cuts happening in the near future, it could be that overall vanilla debt might end up giving you suboptimal returns post-inflation. So I think it makes sense.
Yes. Even if, let's say, we don't want to take exposure to credit, we have been very vocal to our clients in portfolio allocation that you take long duration paper calls. You take government securities which have duration of more than 10, 15, 20 years. Because see, if you look at the West, US Fed has cut interest rates, Bank of England, ECB, everyone has started cutting interest rates. Eventually, India will also, RBI will also start cutting interest rates. So our repo, which is at 6.5, might move towards 5.75 over a period of time. So when the Indian yields will also fall down, probably investors who invest today at a YTM of 7.25 in a 10-year or a 15-year government security might also end up making a little bit on the capital gain, which could be in the range of 8.5-9%. So 9% might also look poor to investors, but we have to see that without any credit risk, with complete liquidity, if we target 9% kind of returns from debt, it's not bad. See, we all have to see real returns. Inflation is still around 4.5%. Even if you make 8.5-9% from debt, then also your positive real returns, still lies 4.5% kind of.
So overall, what I see is that what I hear from the experts is that the basic tenets of wealth management or managing money overall remain the same, irrespective. Like the French say, the more things change, the more they stay the same. So irrespective of how markets are moving, maintain asset allocation at all points of time. Have your clearly have one's short-term, medium-term, long-term goals in your mind while taking any kind of investment decisions. Don't get tactically very swayed by what is happening in the market. Don't go extremely bullish when you are hearing all good things. Don't go extremely bearish when you start hearing negative news. And explore some options which are not available over the counter in the market, right? So for example, like Vinayak mentioned, there are some high bonds and AIF opportunities which are available with centricity, which one might not be able to access through the OTC market. So there those can be explored. And even in equities, one can look at very highly curated and researched opportunities in the unlisted space, not only directly but through other specialized instruments, also private equity funds, etc. Some strategies that we're doing, which we'll cover in probably another video. So overall, thank you to both.
Just before we end, I think I will also add that within equity also you can diversify and you can manage volatility quite a bit. If we look at unlisted, I think Sachin can highlight. Probably we have not seen the correction what we have seen in public equity, same in the unlisted space.
Yes.
Because of low liquidity, we try to have less fall in unlisted space. So within equity also, if you build a decent amount of portfolio into unlisted space, I'm not saying early stage VC companies, maybe mid-mature stage to mature companies, pre-IPO companies, there also relatively you can diversify. I don't see that. Probably Sachin can highlight that. We have seen 10% correction in indices. Stocks specifically might have corrected 20-25% as well on the public equity side. But on the public equity side, I don't see more than 5% correction on any of the stocks, I think.
Yeah, I mean, there has been some corrections, but see, whenever we are choosing unlisted, companies, at a broader market, I think that has fallen by 5 to 8% kind of range. But the kind of basket we have made, because all these companies are zero debt companies, are growing very fast, the valuations are in our favor. So the fall has been almost 3 to 4%, and all these corrections are, I think, very, very healthy, whether it is listed or unlisted. So what happens whenever there is a correction in the market, it brings sanity to the overall market, because in a bull run, we see a lot of companies getting into the froth zone. Like we have seen into railways, defense, some of the PSU, some of the infra companies. So some manipulation starts happening into those companies. So these corrections are very, very healthy, and a good fund manager always utilize this as a.
They are actually looking for these.
Yeah, they are always looking for this.
So overall, friends, as you would have heard, things are going well in our favor. We are definitely, as Mr. Modi says, in a Amrit Kal era. So we don't have to worry too much. You guys have a very, very good Diwali. Enjoy with your family. One can look at work always, but this is the time to have spend more time at home. Have fun, enjoy the festivities, and see you in another episode covering another topic sometime soon. Thank you so much, friends, for listening to us, and stay tuned.
Happy Diwali.